On June 25th, 2024, the Government of Canada will be revising the capital gains inclusion rate. Now there's a certain amount of confusion about this change, so let's take a moment to make sure we understand exactly what is changing and how it may or may not affect us. So what are capital gains? What are capital gains taxes, and who pays these kinds of taxes? These are all questions swirling around on social media, and everyone seems to be putting their own spin on it. While I won't promise to not put the new capital gains inclusion rate into some perspective, I will certainly promise to not present any false information or to leave out any important pieces of information either. If that sounds like a good deal to you, then keep watching. Essentially, a capital gain refers to the profit generated from selling a capital asset for more than one paid for it. This does not refer to selling merchandise in a store. Merchandise would be considered a consumer asset. The revenue earned from selling it would be sales revenue, and that revenue would be subject to income tax, not capital gains tax. Capital gains are earned from the sale of capital assets, which are assets that are used in the production of goods and services. These are generally expensive assets, such as stock, real estate, a business equipment, or even intellectual property rights. Now, capital gains tax has always excluded one's primary residence because we all need a place to live, and when a person sells the house they live in for more than they paid for it, the chances are pretty good that they are also going to have to pay more for the house that they move into. The primary residence exemption is not changing with the new capital gains policy. Enough said. So essentially, Canada will now have a different inclusion rate on capital gains than it had before. This is not to be confused with a tax rate. The marginal taxation rates are not changing. So, in a nutshell, here's the change. Rather than paying one's marginal tax rate on just half of a capital gain, Canadian individuals, corporations, and most trusts will now pay tax on 2/3 of a capital gain. Now, you may have heard about the exception for capital gains below $250,000. That is true for individuals, but not for corporations or most trusts. Those entities will now face a 66.66% inclusion rate on all capital gains earned, starting from the very first dollar. Individuals, however, will face a 50% inclusion rate on any capital gain up to $250,000, and then they will face a 66.66% inclusion rate on any capital gains above $250,000. Now remember, 50% and 2/3 represent the fraction of a capital gain that will be taxed. The remainder of the capital gain is tax-free. So just to be clear, let's take a look at an example. Let's say John, an individual, sells an investment property that he bought for $1 million, but he manages to sell it for $1.6 million. John has earned a capital gain of $600,000. With the new inclusion rate, John will pay his marginal tax rate on 50% of the first $250,000 of his capital gain. That would be $125,000. John will then pay taxes on 2/3 of the remaining capital gain, which would be $350,000 in this case, and 2/3 of $350,000 would be $233,333.50. Therefore, the total amount of taxable income from the sale of this investment property, adding together the amounts we get from these two different inclusion rates, would be $358,333.50. Now remember, that amount is not the tax. That's just the amount that will be taxed. The rest of the capital gain would be tax-free. Now let's figure out how much tax John will pay on his $600,000 capital gain. At the highest combined Ontario and federal income tax rates, which would be 13.16% and 33% respectively, John would pay 46.16% tax on $358,333.50, which would amount to $165,406.74. Please bear in mind that in the interest of transparency, I'm using the highest marginal taxation rate for Ontario, the most populous province in the country. But I should also point out that Ontario happens to have the lowest marginal tax rates in the country, with the exception of Nunavut. I should also point out that for an individual to even reach this marginal tax rate, they would need to reach $220,000 of income in a given year. Now, taken as a total amount on the $600,000 capital gain, John will end up paying $165,406.74 in tax on a $600,000 capital gain, which ends up being just 27.6% of the entire capital gain. Now, to put that in perspective, most working Canadians pay a higher marginal tax rate than that on their incomes, the incomes they earn from working, even on incomes as low as $56,000 a year.
It's crazy.
As far as the oft-repeated argument that this change to the inclusion rate will punish farmers, entrepreneurs, and doctors who build up equity in a business throughout their careers and then rely on the capital gain from selling their business to fund their retirement, well, there's a little something that's being left out from that argument. And that is something known as the Lifetime Capital Gains Exemption. The Lifetime Capital Gains Exemption, or LCGE, currently allows someone to earn a one-time capital gain of up to $1,016,836, completely tax-free. That's even better than the traditional 50% inclusion rate. But it must be generated from the sale of a small incorporated business, farm, or fishing operation. This number started out as $800,000 back in 2014, and it is indexed to inflation, which is why it's such a funny-looking number at the moment. But the federal government is increasing the LCGE to $1,250,000 after June 25th. So, if I might be so bold as to add some perspective here. As working people, this new capital gains inclusion rate really doesn't affect people like us. For the most part, this change to Canada's taxation policy impacts wheelers and dealers, folks who are constantly leveraging their existing capital to do deals that result in quick capital gains. Like this guy.
This painting here, I bought it 10 years ago for $60,000. I could sell it today for $600.
Or this guy.
I don't recall you telling me anything at all.
You son of a bitch. You made over $100 million on that trade.
Yeah, I did. Welcome to the real world, pal.
So please bear this in mind when you hear certain politicians arguing against the changes to Canada's taxation policy, and then think for a moment about whose interests those politicians are serving. Because it sure as heck isn't ours. As usual, I will leave resources in the video description to support every assertion that I have made. I'm Art Lightstone. Thanks for watching.